The Income Tax Act 2025. Today is day 44, and I'm continuing with various deductions under the Act. Starting with the first one, Section 130. This is a deduction which is available in respect of the interest one pays on a housing loan. So, if a person has a housing loan, and he is an individual, he can get a deduction of maximum of rupees 50,000 rupees. But there are various conditions for this deduction under Section 130. The first and most important is that the loan should be sanctioned between 1st of April 2016 and up to 31st of March 2017. Here, the limit is for loan sanctioned. It doesn't matter whether the loan has been dispersed in this date or not. It should have been sanctioned between this time period. This time period is there because at that time it was believed that the market was down. There was not much demand for houses, so that's why this was kind of an incentive for people to purchase houses and take housing loans. So this is the first condition we will check, and this really narrows down a lot of the situations. Only a few situations would fit in this situation, in this condition. So the second condition is it should have been obtained from a bank and financial institution, and it should be for a residential house property. Then the price of the house should be up to 50 lakh rupees, and the amount of loan should be up to 35 lakh rupees. And further, the SSC does not own any residential house on the date of sanction. Means it should not be for his second house or his third house, whatever. The next one is Section 131, which is again a deduction in respect of interest on housing loan. This is again for individuals, but for those individuals who are not covered under Section 130. I think it's kind of impossible for one to be covered under both sections, but still, I have to learn this. It's for an individual not covered under Section 130. The maximum amount of deduction can be rupees 1,50,000, and there are again many conditions for this deduction. The first and most important one will be the loan should be sanctioned between 1/4/2019 up to 31st March 2022. This is a time period for this deduction, for deduction under Section 131. And then again, there are some conditions like it should have been obtained from bank or financial institution, and it should be for residential property. Then the stamp duty value of the property, not the purchase price, but the stamp duty value of the property should be up to 45 lakh rupees. And then SSC should not own any residential house property on the date of sanction of loan. If deduction is allowed any interest here, then the deduction in respect of such interest will not be allowed under any other provision. So if we fulfill all these conditions, an individual can get maximum deduction of rupees 1,50,000 on the interest he pays on housing loan, which has been sanctioned in this particular period. Moving on to the next one, which is Section 132. This is again a deduction in respect of interest, but it is for obtaining an electronic vehicle, an EV loan. The interest we pay on such loan, Section 132 covers deduction for that. Again, the eligible SSC will be individual, and the amount of deduction would be maximum 1,50,000 rupees. And again, there are a few conditions which we need to fulfill in order to be eligible for this deduction. The first one is again it should be taken from bank and financial institutions, but here they included NBFC as well. Means if we have taken loan from an NBFC, it will also be covered under this section. Then the sanction date, again the most important one, is it should have been obtained between 1/4/2019 up to 31st March 2023. Again, then if if deduction allowed for any interest here, then it should not be allowed in any other provision. The next deduction will be Section 133, which is a deduction in relation to donations a person makes. So for this section, any all SSCs are considered to be eligible SSCs, and there is a long list of eligible donations, means a long list of donations that we can make to these organizations or funds, in respect of which we will get deduction under Section 133. So there are many categories. Like the first one is unlimited category. In this, there are all these kinds of funds where we can donate money in order to get 100% unlimited deduction. And in respect of PM drought relief, we'll get 50% unlimited deduction. Means unlimited here means that there is no ceiling on the amount of deduction we make. Whatever is the amount that we donate, we'll get 100% deduction on that amount. And all these funds usually they have the name either national in their name, or PM in their name, or CM in their name, or it is like Clean Ganga Fund or Swachh Bharat Kosh or Fund for Army. These kind of funds, for these funds we'll get 100% unlimited deduction, no cap on deduction, and 100% on whatever amount we donate. Then there is this one fund which is PM Drought Relief Fund. For this we'll get again unlimited deduction, but only 50%. Means like if we donate 10 lakh rupees, we'll get a deduction of 5 lakh rupees. Then there is part B, which is a limited category. In this category we get limited amount of donation. I'll try to explain here. Firstly, limited category, there is we get 100% limited deduction here. In case of 2, this is a memory technique FO in case of 100%, and for 50% the memory technique is HTC mobile. So FO means F for family planning, and O for Olympic associations, means when a company donates to Indian Olympics associations, he will get 100% limited deduction for it. Similarly, for HTC Mobile, H means HDA, T means any temple, mosque, church, further in repair or renovation. Then there is C, C means charitable, but it should be in relation to family planning. Then in mobile, M is used to memorize minority. Let me go over the list here. In part B, limited category, there will be 100% limited deduction if we donate our money to approved institution or local authority or government for promoting family planning. And then there was O, which was for Olympic associations, when a company donates to an Olympic associations or any other institution for development of infrastructure for sports in India. Then there is the case of 50% limited donation. I am saying the word limited here because there is a cap on how much we can donate. I'll go there in a bit. We had the memory technique STC minority here. H was Housing Development Authority. T for temple, gurdwara, mosque, church, whether whatever it is, but it should be for repair and renovation of such. Then we had C for charitable, when we donate to a public charitable trust or government or local authority for any charitable purpose other than for family planning, because family planning was covered here. Then we get 50% limited donation, limited deduction. Then we have donation for promoting minority community in India. Now let's try to understand what limited category means. In limited category, we will get a limited amount of donation, which will be maximum of 10% of adjusted total income. So first we'll check how much we donated in the 100% category, in the 50% limited category, and we'll add up that amount. Then we'll compare that amount with 10% of our adjusted total income, and whichever is the lower, either the amount donated or 10% of ATI, we'll take that as eligible donation, and for that we'll receive deduction. So firstly, ATI means gross total income, excluding income taxable at special rates like LTCG, STCG, and then we'll reduce all the deductions from it except Section 133 deduction. Obviously, this section's deduction that will give us ATI, and using ATI, we'll compare that to actual donations and get the amount for eligible donation. Here is an example of the same. Like a person donated, an SSC donated rupees 25,000 in this 100% limited category, FO category, and then in the 50% limited category he donated rupees 40,000. So the total donations will be rupees 65,000. And then we go to calculate his total adjusted total income. Assuming the adjusted total income comes to rupees 5,40,000, 10% of it will become rupees 54,000. So his eligible donation would be the lower of two, means 65,000 or 54,000. The lower one is 54,000. So 54,000 will become his eligible donation. That's the maximum amount he'll get deduction for. So out of this 54,000, we'll utilize rupees 25,000 first, because on that we are receiving 100% deduction. So 25,000 into 100% will get complete 25,000 rupees deduction. And then for the remaining amount, which will be rupees 29,000, 54,000 minus 25,000 gives us 29,000 rupees. For that we'll receive only 50% deduction, so half of it is 14,500. So in aggregate we'll get a deduction of rupees 39,500 for donating in this limited category. And there are some notes that deduction is not allowed if donation is made in cash for more than rupees 2,000. And then there is this condition for deduction under section 133 for amount paid to charitable trust. It should furnish information of such donation, and there should be verification as per risk management strategy. It's like the case where we made donations to charitable trust under ATG and we received ATG certificate. It's that kind of situation, and that data is then auto filled in the return of the person making donations. Then the third point is donations paid in kind are not eligible for deduction. That is all for this section. Now I'll move on to the next one. The next one is section 134, which deals with rent paid for house property when the person is not receiving HRA. So when a person is not receiving HRA and he makes payment of rent for house property, then he will be eligible for this deduction. The eligible SSC will be any individual, and there is a condition which says SSC or his spouse or his minor child or HUF should not own any house at that place of his duty, because why not stay there only, or at any other place being in his occupation. So if he has a place to live in, he should live there, and payment of rent seems to be artificial in this case. Coming to the main point, which is the amount of deduction he will get the lower of these three, either 5,000 per month, which means if you multiply it by 12 months, he can get a maximum of rupees 60,000 deduction. It has given 5,000 per month because sometimes the SSC can be making payment of rent for only like 2 months or 3 months. So for that purpose, it says 5,000 per month. But assuming he's there for full year, the maximum deduction he can get is rupees 60,000. Then there is 25% of total income. Total income for this section would be GTI minus all deductions except this one, obviously, section 134 deduction. Then the third one is rent paid minus 10% of total income. Let's take an example where a person is paying a rent of rupees 70,000 per annum and he's there for the full year. And then he has a total income of rupees, let's say, 2,30,000. For the sake of this example, how much deduction will he be able to obtain? The first one will be rupees 60,000. The second one will be 25% of his income, which will be 2,30,000 minus multiplied by 25% gives us 57,500. And for the third condition, it will be rent paid, which is 70,000 in this case, 70k minus 10% of his total income, which will be 23,000. 23k. This gives us an amount of 47,000 rupees. So we'll see the lower amount of these three, and he will be eligible for that. So clearly, the lowest one is rupees 47k. So the SSC will be receiving a deduction of 47k in this case. Now, a question may arise in this case that while we are calculating the amount of deduction for section 134 and we are calculating the amount of deduction for section 133, here it was also written GTI minus all deductions except 133. So it is technically very difficult to calculate how much ATI is in this case, or how much the total income is for section 134, because like we are calculating for ATI for section 133, we have to reduce all deductions. So for that we have to reduce deduction under section 134 as well, but we don't have that yet. So we go to section 134, we try to calculate deduction there, but it says again GTI minus all deductions. We again do not have all deductions because we haven't calculated section 133 deduction yet. So this is kind of a tricky situation here, but it has not come in exam ever, so it's not relevant, but it is possible to solve it using simultaneous equations. Simultaneous equations is not relevant for the exam. So moving on to the next one, which is section 135, donation for scientific research. The eligible SSC in this case will be all SSCs, except SSCs having income under head PGBP, because these guys are getting donation in section 45 subsection 3, I think. Already they are getting 100% deduction there, so we are not considering any deduction in this section 135. The amount of deduction will be 100% of donation. Then there is this condition that if we are making a donation of more than 2000 rupees, we can make it in any mode except for cash mode. Then the donor should be entitled to deduction under section 135 subject to the following. Subject to that he furnishes the information relating to such donation, and there is verification. Means again it's like that ATG kind of verification where you have to show you actually made the donation, and it appears in your return as well. Moving on to the small sections of section 136 and 137, which is in relation to the donation made to either political parties or any electoral trust. So, if an Indian company is making such donation, it will be covered under section 136. If it is any other person making such donation, it will be covered under section 137. The amount of deduction will be 100% of donation, and there will be no deduction if the donation is made in cash. Then moving on to the next deduction, which is under section 140, it says it provides a deduction for new startups. So if there is a startup who is in the form of a company or an LLP, it will get 100% deduction for three consecutive tax years out of the 10 tax years from incorporation. 100% deduction on its income, of on its profits, I mean. He will get 100% deduction on profits for three consecutive tax years out of the 10 tax years from the tax year of incorporation. But there are certain conditions that it needs to fulfill. That firstly, it should be incorporated between this date on 2016 up to 31 3 2030. Then the turnover should be up to 300 crore in the year in which it is claiming deduction. And then it should have that eligible startup certificate by IMBC. It's like that certificate issued by DPIIT. Here are the conditions in detail. So it should be a eligible SSC is a company or LLP who is an eligible startup. And how do we identify it's an eligible startup? It should be engaged in innovation, development, and improvement of either products, processes, or services. And it should be scalable business model with high potential of either employment generation or wealth creation. So then it will become eligible startup. Then it also has to fulfill these conditions, that it should be incorporated between this date and its turnover should be up to 300 crore in the tax year in which it is claiming a deduction. Then it should also hold a certificate for eligible businesses. Then the amount of deduction 100% of profit for the three tax years out of 10 tax years. Because this option has been provided because startups usually lose money in their initial phases, though that's why they are given a choice of picking a tax year from which they would like to exercise such deduction. And once they exercise such deduction, they will have to do it for continuously 3 years, for consecutive 3 years. They cannot pick 3 years and leave a gap in between out of the first 10 years of the startup. And there are these additional conditions. Firstly, it should not be found by split up or reconstruction, means it should be a new business altogether. Then the plant and machinery used should be new, except we can tolerate up to 20% of second hand machinery. And in case it has imported second hand machinery, then that is also considered as new machinery only. This condition is there because in case of imported second-hand machineries, we know that nobody has claimed deduction in respect of the purchase cost or the depreciation for such machinery. That is why the income tax allows imported second-hand machinery to be treated as new machinery only. Then its account should be audited by a CA. Moving on to the next section, which is section 146, and it relates to the deduction in respect of new employees. So when the SSC, when a business employs new employees, they will get a deduction under this section. This is the section which I used in the case of ICOs or softwares in office. At that time, it was called, I think, section 80JJAA. So it is available for all SSCs who are engaged in business and who are liable for audit as per the requirements of section 63. Then who are the new employees that they will get the deduction for? New employees will mean those employees who have a salary per month of up to 25,000 rupees, and they have worked at least 240 days in the business. So if they have worked 240 days or more during the year, they will be considered as new employees. But if they have worked for less than that, they will not be considered as new employees for the current year, but they will be considered as new employees if they are continuing in the next year. So if they are still in the firm in the next year, they will be considered as new employees. And in the next year, obviously, they will be there for the year, so they are fulfilling the 240 days criteria. But if you are engaged in the business of footwear or apparel or leather products, then the criteria becomes 150 days only. Then the employee should also be participating in RPF. Otherwise, they will not be considered as additional employees for this section. And you have to make the payment of their salaries through account paycheck, demand draft, or ECS only. Means you cannot pay them in cash. Then what will be the amount of deduction? The deduction the SSC will get will be 30% of the amount paid to such employees, and it will be spread over 3 years. Means if we pay like 10 lakh rupees of additional employee cost this year, then we'll get 30%, which is 3 lakh rupees in the current year, and 30% in the next year, and 30% in the year after. This is also a little description of who new employees are. So, for a new business, all its employees are considered as new or additional employees. But for old businesses, for existing businesses, the net increment in employees will be considered as additional employees. Means like they have 500 employees already, but during their year, they employed 15 new employees during the year. So we'll take the net amount of three employees which have joined new joinees during the year, and we'll take that cost and allow deduction on that amount only for the three additional employees only. Here is a bit more detail of this section. Section 146, deduction in respect of employment of new employees. Eligible SSC is any SSC engaged in business and to whom Section 63 applies. The deduction will be 30% of the additional employee cost deduction for 3 consecutive years. Now, there is a point to be considered here. This is a deduction which we will get for the cost we incur in the current year. Means like we are incurring during the tax year, we have additional employee cost. Tax year 26-27, we have an additional employee cost of 10 lakh rupees. So we'll get a deduction of 30%, which means 3 lakh rupees in the tax year 26-27, and then we'll get 3 lakh rupees in tax year 27-28, and 3 lakh rupees in the tax year 28-29. So this deduction is provided to us for the cost we incur during the tax year 26-27 only. So during the next tax years, we'll simply just claim the amount of 3 lakh rupees as deduction, and we do not have to check whether those employees are still in the firm or they have left or whatever, whether their salary is more than 25,000. We do not have to check any conditions in the next year, because the deduction is for the tax year 26-27, and once we have verified they fulfill the conditions during this tax year, the SSC will be eligible for the deduction for 3 tax year without having to check anything again. Then there is additional employee cost. What is additional employee cost? It means the total emoluments paid or payable to the additional employees. Then there is a case, it is explaining now who are considered to be additional employees. For existing businesses, the additional employees, there will be nil. Additional employee cost will be nil if there is no increase in the total number of employees, or the payment is made other than through account paycheck, DD or ECS mode or other electronic mode. For new businesses, the emolument paid to all the employees during the tax year are considered as additional employees. Additional employees do not include. This is a negative sentence. Earlier, I explained in the form of positive sentences. So this is going in the other direction. So additional employees do not include those for whom we pay more than 25,000 per month, or who are employed for less than 40 days or 150 days, and who do not participate in RBF. Means the employee should be participating in RBF to be eligible for this deduction. And then for those employees who are being paid by the government under employee pension scheme, they will not be eligible under this section. Then this is the point of new tax year, means we don't have to check the condition in every tax year, it's for the first year only. Then the books of accounts should be audited by the books of accounts is audited by a chartered accountant, and the audit report should be submitted up to the date of audit report. Then only he will be eligible for such deduction. The next section is section 147, which is relating to the offshore banking units, or OBU, or International Financial Services Center. So this section 46, 147, it says that if there is a bank having an offshore banking unit in an SEZ, it will get 100% deduction on its income for 20 tax years, and it can extend the period of the deduction to a further 20 tax years if it gets such approval. Then for units in IFSC, they will get a deduction for 20 tax years out of 25 tax years. Let me study this in detail now. Section 147. The eligible SSC is any scheduled bank, means an Indian bank, or a foreign bank having an offshore banking unit or branch in an SEZ, or there is a unit of IFSC. Now, what an IFSC is, I will try to explain a little. And IFSC is a unified authority. IFSC is it deals with those businesses who are engaged in the financial products, financial service, financial institutions, those kinds of businesses. They engage in business in this area called IFSC. It's an area where banks, insurers, fund managers, and other financial firms can operate in foreign currency under a unique regulatory and tax framework, enabling cross border financial services within India. This is just the definition. Then our main concern is about the deductions. So a bank branch in SEZ will get 100% deduction on its income for 20 years beginning from relevant tax years. What is a relevant tax year? It is the year in which it receives approval to do banking business in the SEZ. It doesn't matter when it actually starts the business. It tells us when it receives the approval for doing business in banking business in SEZ. That year becomes a relevant tax year, and starting from that year, they will get a deduction of 100% for 20 tax years. Now, earlier, what used to happen under the old act and under this act as well, before the amendment as per Finance Act 2026, the period of deduction was 10 years only. It was only 10 years here. So for some businesses, that period may have ended before this change was made, and so that for them, they will not get any benefit under of these 20 years under this section. But there is one exceptional case set out in this section. It is when a business was enjoying this deduction for 10 years, and the period of 10 years ended on 31st March 2025. So if the period of 10 years ended on 31st March 2025, for such businesses only, they will be allowed to enjoy 20 years deduction. Means they will be given additional tax 10 years as 100% deduction, but that period of 10 years will start from 1st of April 2026. So, so to clarify, their period ended on 31st March 2025. So they were enjoying the deduction up to tax year 24-25. Then it ended. And then in the new act as well, the Income Tax Act 2025, there was a period of 10 years. So they did not have any deduction. But now in this exceptional case, they are getting a deduction starting from April 1st, 2026. Means from tax year 26-27, they will be able to enjoy further 10 years of deduction. So they enjoy 10 years deduction up to tax year 24-25, and then tax year 25-26 they did not have any deduction, means they would have paid taxes. And then starting from tax year 26-27, they will again get a further period of 10 years for enjoying these deductions. This is for the bank branch in SEZ. Then for a unit in IFSC, the deduction will be 100% of income for any 20 consecutive tax years out of its first 25 tax years. Now, these are the notes that we need to consider. This is about the approval. Relevant tax year starts from the date of approval. And then, if the operations of these businesses have started after 1/4/2026, the deduction will only be allowed if it is not formed by splitting up or reconstruction or reorganization of or transfer of an existing business. Means it should be a fresh business. Then only it will be eligible. Then talking about the income on which it will be able to get deduction, the income means any income from offshore banking unit in an SEZ or any income of a unit in IFSC. They will get a deduction on that. Then there are these two special cases. The first one is transfer of an aircraft or ship which was leased by a unit of IFSC, and such unit has commenced operation up to 31st March 2030. I have an example for this. Let's say this is Harry Limited. It's Harry Inc. Let's say this is, and it's a company based in US. What they do, they are lending aircraft is on lease to Air India, and for that lease, Air India is paying them lease rent. So normally, Air India, when Air India pays them lease rent, they will have to pay taxes on such lease rent. But if Harry Inc. decides to set up a unit in India as Harry Limited and it sets it up in an IFSC, then Harry Limited will get the deduction. Means it will not have to pay any taxes on such lease rent for 20 consecutive years. It will get 100% deduction on such lease rent. And in case it decides to end the lease by transferring such aircrafts to Air India altogether, then it will not have to pay taxes on such transfer as well. So it's basically encouraging the foreign companies to set up units in IFSC. Then there is this banking business. Whenever anyone is engaged in a banking business with any undertaking which is located in a SEZ, it will get deduction on such income. Like HDFC Bank, whether it's the Mumbai branch or any other branch, it's engaging in a banking business with a unit which is present in SEZ. Then on such income which it earns from such banking business, it will get a deduction under section 147. 147. Similarly, if it engaged in a banking business with any developer who operates or maintains this SEZ, then in that case also the income he earns from such banking business will be eligible for deduction under section 47. And these are the additional conditions. We have to we have to obtain a certificate of CA in form number 35, and a copy of permission needs to be filed along with the return of income. Now, for the last part of the day, we have two sections, section 151 and section 152. These deal with the cases of royalty. Section 151 is about the royalty we receive from books of literacy or artistic work or of scientific nature. And section 152 deals with the royalty received from any patent. In this case, the eligible SSC is a resident individual. Any resident individual is an eligible SSC, and the amount of deduction will be the amount of royalty received or rupees 3 lakh, whichever is lower. So the maximum amount can be 3 lakh in this case. Now, for the books and literacy, the case of royalty from books of literacy, artistic or scientific nature, in that case, the eligible royalty means the amount we'll put in this first part is if in case we receive a lump sum amount of royalty, then the amount we receive, or otherwise means we continue to receive in small amounts, then in that case the royalty eligible royalty for this section would be maximum 15% of the value of book. Means if the value of book is 1000, we'll get 15%, which is 150 as the royalty received, to put here in the royalty received section, and then we'll compare it with rupees 3 lakh rupees. Then there is just one point for both of these cases. It's that when the royalty is earned outside India, means when we receive royalty from outside India, Then in that case, what happens? In that case, this deduction will be allowed only if such royalty is brought in India in a convertible foreign exchange, and it should be brought in India within 6 months from the end of tax years or time allowed by RBI. Means firstly, it should be brought in India in a convertible foreign exchange, and it should be brought within 6 months from the end of the tax year, or if there is any other time as specified by RBI. That's all.